as I said, it's not the first time it's happened. It's actually happened in the 1950s, and it's happened in the past too. But to understand it all, you'll understand that since 2008, everything became ultra cyclical. Before then, we had a business cycle that shifted a lot. It wasn't as clear. There was much more diversification in investments. But since 2008, everyone's like, oh my God, everything is a bubble all the time.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge.
Raoul Pal dives deep into Bitcoin and crypto, exploring trends, opportunities, and big ideas. Stick around to discover more together.
We now believe that diversification is dead, and the best thing is hyper-concentration, which goes against what many, many people will tell you, but we'll explain why. And it all comes down to the biggest macro variable of all time, the most important. And I'll explain why this has happened. But what the issue is here is the global governments and central banks are increasing liquidity to manage debt at 8% a year. 8% a year is actually the devaluation of fiat currency that you don't see. It's kind of hidden, and we'll come into how it's hidden later. But this 8% is your hurdle rate to unfucking your future, plus you need to add inflation. Yes, it's in addition to this, because inflation is not the same as debasement. So you've got an 11% hurdle rate on any investment that you have. And once you understand this, it changes what you do with your money. Because don't forget, an asset that you buy is future deferred consumption. Some point in the future, you want to release that. And because you've locked money up for an extended period of time, you expect to be rewarded above what is happening to debasement or inflation. That is the whole point of investing. Now, what is happening is most things aren't doing that. We'll come into that. So anyway, just remember this, 11%. If your investments are not hitting 11%, you are getting poorer. Okay, the everything code. It all starts with this, the magic formula. The magic formula is how you think of trend rate of GDP. It's actually driven by population growth, productivity growth, and debt growth. Those are the three key factors that drive GDP over time, and it's consistent everywhere in the world. So let's start looking at these. Trend rate of GDP has been falling over time since the 1950s and is now around 2%. Okay, so why is that? Well, the working age population has also been falling. So the working age population means that it drives less economic activity. So the trend rate of growth there has been falling too. Also, productivity has been falling over time, which is extraordinary considering the technology revolution that we've had. It has not driven productivity as much as it could have done. Yes, the measurements aren't great, but also it's a factor because of an aging population, and we'll show that shortly. Debt growth. Well, debt growth appears to have peaked back in, let's say, 2009. We had the pandemic spike, but really it has been trending higher over time, and the structure of debt has changed over time. You see, private debt, the private sector has been deleveraging. It's now down to about 100% of GDP. Total debt is still about 340% of GDP. When we get to private debts, it's about 120% of GDP and has been falling, which is good. But total debt has offset it, the public debt. The government has actually taken on the debts as the private sector's delevered, because it's trying not to let the deleveraging slow down GDP any further. It has increased debt. Okay, so that's how the three dynamics play out. But let's look at the most important one of all, demographics. Demographics is the basis. When I first started GMI, the first article I ever wrote was debt, demographics, and deflation. And that has been my framework ever since.
Michael Saylor has once again captured attention with just 2 words: be unstoppable. The message arrived as Strategy's treasury surpassed an incredible $70 billion in Bitcoin holdings, confirming its dominance as the world's largest corporate Bitcoin holder. With 639,835 BTC under its control, Strategy is miles ahead of competitors, making it clear that Saylor's conviction is stronger than ever. The scale of Strategy's holdings is staggering when compared to other companies. Mara Holdings, the closest contender, holds 52,477 BTC, while Tesla owns just 11,509. Even Coinbase, at 11,776 BTC, barely makes a dent. Adding up the next 10 companies still doesn't come close to Strategy's massive lead. It has effectively built a Bitcoin fortress, bigger than miners and exchanges that keep the network alive. While Bitcoin's price continues to swing wildly, soaring above $124,000 in August before slipping to $106,000, Saylor's company shows no hesitation. Strategy's principle remains simple: accumulate, hold, and above all, be unstoppable.
And it's all driven by this one thing: the servicing of the debt. You see, back in 2009, 9, everybody, every major government around the world gave themselves a debt jubilee. They paid 0 interest on any debt, and most of the private sector got to 0 interest as well. That allowed everybody to restructure debts. The private sector has been paying it off. The government has been increasing to offset that. But what they've done is they've created a 4-year cycle, or they had created a 4-year cycle. We'll come on to the shift in that cycle based on the debt refinancing cycle. So it's about a 3 to 5 year sector is where they've been operating at. And every 4 years, they've been basically refinancing that debt by printing money. And that happens over a 3-year period. And then there's usually a period where they withdraw money from the system before they start again. But each time it keeps going up. And that creates these weird cycles. So Bitcoin, some people thought it was the halving cycle. It's not. It's the debt refi cycle, because it happens in all assets, the NASDAQ, commodities, everything. And it's driven by this like spring, summer, fall, winter. And they're all corresponding to how much money they're printing at any one period of time. Winter's when they're not printing money, but the others are when they are. And so those are these economic seasons that we talk about. So recently we noticed that, hey, the ISM, and you've heard Julian and I not struggling, but trying to understand, okay, what's changed in our framework? Our job is to understand and double test our framework at all points. So when something major is changing, which was the ISM not fitting the 4-year perfect sine wave, we started thinking, what's going on here? The ISM is more subdued than it has been ever. And we found out that the debt had been moved in 2021-22 because interest rates went basically back to 0. They managed to extend the curve by issuing further out, and they extended the debt maturity from 4 and a bit years to 5.4 years, creating a new longer cycle. Now, we don't know what length the next cycle is. It depends on where they refinance this entire cycle at. But right now, we know we've probably got an ISM and a business cycle that extends well into late 2026, and that will affect asset prices. So this is why markets have been acting, well, crypto markets have been more subdued than people expect. And we'll come on to that in a second as well. The other thing is interest rates. Interest rates haven't needed to yet come lower, but now we're seeing the urgency from Scott Bessent, who understands the Everything Code, and Steve Mirren and Trump all saying we need to get rates lower. Why? Because we've got $9 trillion of debt to roll over the next 12 months. It's this 12 months that is the key to everything. It's this 12 months where maximum money printing comes.
Bitcoin's price has once again become the center of heated debate, with traders split on whether the next big move will take it towards $60,000 or rocket it past $140,000. After falling more than 12% from its peak above $124,500, The world's largest cryptocurrency is testing the patience of both bulls and bears. For the cautious side, echoes of 2021 loom large. Back then, Bitcoin hit record highs before tumbling more than 50% in a matter of weeks. Analysts now see similar chart patterns forming, with BTC sitting just below a potential reversal zone. A breakdown from here could drag prices towards $60,000 or even lower if momentum fails. Optimists, however, argue the story is different this time. With the Federal Reserve cutting interest rates and Bitcoin finding support near its 200-day moving averages, some see this dip as a healthy correction. If BTC can clear resistance around $113,000, targets of $140,000 and possibly higher remain firmly on the table. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to BitcoinZella for daily news all for free. That's all for today's video. Until next time.